Warren Buffett is the best investor ever. If you had invested $1,000 in his company when he started it, it would be worth more than $30 million now. That sounds unbelievable, but how did Buffett do it? The answer is he knows what most people don't, and he follows a few simple rules that you can use in your daily life. Stay tuned, because by the end of this video, you will learn all of them. One, the hiring philosophy. According to Warren Buffett, we look for three things when he hires people in his company. We look for intelligence, energy, or initiative, and lastly, we look for honesty. And if they don't have the last one, the first two will destroy you. Because if you're going to get someone without honesty, you want them stupid and lazy. I mean, yeah, you don't want them smart and active. 2. Human behavior in markets. Buffett keenly observes human behavior in markets. He identifies a pattern. They get very excited during bull markets, and they look back and they say, I made money last year, and I'm going to make more money this year. So this time, I'll borrow some money. Or, the neighbor says, you know, I missed out last year when that neighbor who was dumber than me made a lot of money. So I'm going to join in this year. They're always looking back. And when they look back and they see a lot of money having been made in the past few years, they jump in and they just push and push and push on prices. And when they look back and they see no money having been made, they just say, this is a terrible place to be. So they don't care what's happening in the actual business. And it's amazing, but that creates a huge opportunity. A huge opportunity. 3. The evolution of Buffett's investment strategy. Warren Buffett's investment strategy has evolved over time. According to Warren Buffett, Ben Graham instilled in me the discipline of making investment decisions based on tangible numbers. The concept was ingrained in my thinking back in 1949, leaving a lasting impression. I adopted what I refer to as the cigar butt approach to buying stocks, envisioning the process as strolling down the street, searching for discarded cigarette butts. Picture finding a soaked, unsightly cigar with just one puff remaining. You pick it up, take that single puff, gruesome but free, and discard it. This method, while profitable on a smaller scale, proved to be a mistake when aiming for substantial returns. I've come to realize that it's far more effective to invest in outstanding businesses, making the shift from seeking cheap opportunities to focusing on acquiring exceptional businesses even at a fair price. However, I have a traditional belief that I can only expect to make money in things that I understand. And when I say understand, I don't mean to understand, what the product does or anything like that. I mean, understand what the economics of the business will look like 10 years from now or 20 years from now. I know in general what the economics will say Wrigley chewing gum will look like 10 years from now. The internet isn't going to change how people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way and you've got Doublemint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers will look like on Wrigley, but I'm not going to be way off. 4. Lessons from mistakes. When I look ahead at something like that, I can evaluate that company because it's within my circle of competence. I understand what they do. I understand the economics of it, and I understand the competitive aspects of the business. But the biggest mistakes I've made by far, the biggest mistakes I've made by far are mistakes of omission, not commission. I mean, it's the things I could have done, they were within my circle of competence, and I was hesitating. And those are the ones that hurt. They don't show up anywhere. I probably cost Berkshire at least $5 billion, for example, by hesitating 20 years ago or so, when Fannie Mae was having some problems and we could have bought the whole company for almost nothing. And I don't worry about that if it's Microsoft because I don't know it. Because Microsoft isn't in my circle of competence. And so I don't have any reason to think I deserve to make money out of Microsoft, or out of cocoa beans, or whatever. But I did know enough to understand Fannie Mae. And I missed it. And that never shows up under standard accounting. But I know the cost of it. I know, I let it go. And those are the big mistakes. and I've had plenty of them. And you'll only know about them in the annual report. And I sometimes don't want to tell you. Unless I tell you about them in the annual report, you won't know it, because it doesn't show up under standard accounting. But omission is much bigger than commission. 5. The long-term perspective. There are big opportunities in life that have to be taken. We don't do many things, but when we get the chance to do something that's right and big, we have to do it. And even to do it on a small scale is almost as bad as not doing it at all. I mean, you really have to. You have to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if, when you graduated from here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You would get very rich, because you'd think very hard. Each one of you went to a cocktail party and somebody talked about a company. He didn't even understand what they did or couldn't say the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. In terms of our fully owned businesses, we're not going to sell, no matter how much anybody offers us for. I mean, if somebody offers us 3 times what something is worth, that See's Candy, the Buffalo News, Board Shines, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I own 100% of Berkshire, because that's the way I want to live my life. I have all the money I could ever want. It only means a change in the newspaper story when I die, and the amount of money the foundation gets, and the end of relationships with people I care about, and people who join me because they think it's a permanent home. To do that, just because someone waves a big check at me, would be like selling one of my kids, because I'll be getting a big check. So I won't do that. And I want to tell my partners I won't do it, so they're not let down by me. More and more, with some stocks, we have that approach now. If we were always short of funds and all kinds of opportunities came, we might have a slightly different approach. But our tendency is not to sell things, unless we get really disappointed, maybe with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. But we're not going to sell just because it looks too high. And that's how I invest. I hope you learned something from this video. If you did, please like, share, and subscribe. And remember, the best way to learn is to do. So go out there and start investing like Warren Buffett. Thanks for watching.